Okay, hello, everybody. Can you guys hear me, please? Everybody, please just confirm they can hear me perfectly well.
Yeah, I can hear you.
Can hear you.
Okay, panelists, I think we're all online waiting for Emeka to join us. First of all, good evening, everybody. Thanks for coming through once again. It's our second webinar. Um, as you can see, who says Nigerians can't be punctual? 6 o'clock, we're dead on time. So, welcome to today's webinar, Financing Oil and Gas in Nigeria. I'm not hosting this webinar. One of my colleagues, Debola Adeyemo, is going to be hosting this webinar. So I'll be handing over to Debola now. Debola, over to you. I'm going to stop sharing. Okay.
Okay. Okay. I think you just need to give me permissions to do that. I'll just get started. Good afternoon, good evening, everyone. Thank you for joining us for this webinar today. My name is Debola Adeyemo, and I'm one of the organizers of this event. If this is your first time joining us, I'd like to extend a warm welcome to you. And if you've joined us previously, welcome again. So a little about me. My background is chemical process engineering with a focus on operations and engineering in exploration and production. My experience has been across Africa, Europe, and the Middle East. And now I work in global concept development for upstream projects in based out of London. So today's webinar is titled Financing Oil and Gas in Nigeria. And that's what we're going to talk about today. We've got some really excellent speakers lined up who are going to share their experience and insights. And before I go ahead, I'd just like to say a few things about the organizers of this event. So who are we? We're an experienced set of oil and gas professionals who are passionate about oil and gas and energy development in sub-Saharan Africa. And our aim is to bring together a diverse group of professionals across different disciplines across the entire oil and gas value chain to share knowledge and expertise and to create value with the intent of creating a platform which supports growth and development of the oil and gas industry in sub-Saharan Africa and beyond. So, like I said, we've got three excellent speakers who will be sharing their insights with us today. Starting off will be Dayo Layode, whose specialties are financial advisory, project finance, and investment evaluation. He's got over 12 years of experience in oil and gas across a range of areas in the finance space, and he's MBA qualified from Manchester Business School. Then he's going to be followed by Emeka Ekunife, who's again very experienced across a vast array of corporate finance and advisory, investment banking, and financial services. His experience spans both oil and gas and other industries as well, such as mining and hospitality, with a focus on aspects such as loans and structuring, syndication, underwriting, and trade finance. Um, Finally, we'll have Dironi, who's head of energy corporate banking group, specializing in debt, capital finance, and financial services. Again, well experienced across oil and gas and also power and telecoms. So before we get into the presentations from our speakers, just wanted to give a bit of an overview of the oil and gas industry for anybody joining us who is not as familiar with the industry. So the talks today are going to be split into three groups covering upstream, midstream, and downstream. So when we talk about upstream, this refers to the exploration, production, and drilling aspects of the industry, where you find the resources, get them out of the ground, and then deliver them in a useful form, typically onshore, offshore, etc. And then you have midstream, which primarily deals with transportation and storage of those products. And, it's a term typically used to describe pipeline transportation, but also could involve other modes such as, vessels or road transport. There is some processing also covered under midstream. And to some extent, there may be some overlaps between what some people describe as midstream and downstream. And finally, the downstream section really talks about the refining, distribution, and marketing aspect of the industry, and is primarily focused on the aspects closest to the end user. So we're talking about, your gasoline going to the final end user, gas, petrochemicals, etc. Those are the kind of aspects will be covered by the downstream. So without further ado, I would like to hand you over to our first speaker, Dio, who's going to be talking to us about upstream. Over to you, Dio.
All right. Okay, so good evening, everyone. So as Ola said, my name is Oladayo. I currently work in an IOC doing finance advisory, and I'd just like to, take a few minutes to share my experience on in upstream oil and gas financing. So I've worked in the upstream for about 12 years. Prior to that, I used to work in KPMG as a financial advisor. And one thing that's been constant through my 12 years working in the oil and gas industry in Nigeria is that production has always been around the 2 million barrel mark. And that is not because we have a resource constraint. All of the troubles we have are what we call in the industry above ground. Um, so you see, if you look at the chart, we have the JV and marginal fields doing slightly above a million or 1.3 million barrels a day, and that's even dropped. And one of the major reasons why this trajectory has been pretty much constant or even declining is that we do not have enough funds to or enough financing to grow our production. So there's a lot of potential, but there's not enough money in addition to the other myriad problems we have. One thing I would like to mention here to take away is that in financing, project financing in the upstream is really in the JV space. You really can't do it for PSC, and that's because it takes about 20 years to develop and it costs a lot of money. The average PSC development costs about $10 billion. There's no bank that's going to get involved in that over a 20-year period. Okay, so with that backdrop in mind, what are the basics of upstream project finance in Nigeria? I have this donut chart here that just looks at what it is, why do we have to do it, who is involved, and how does it get done in Nigeria? So it's an alternative financing mechanism. Basically, the default financing mechanism is for whoever is interested in prospecting oil and gas to bring out their money and use your equity. But as we know, equity is not always enough, especially as we continue to see more Nigerian companies coming into the upstream oil and gas space. So you usually have to have banks syndicates. So you have a syndicates program where banks come together and they loan funds for projects. One of the reasons they come together as a syndicate is to share risk, and we'll get to that on the next slide. The reason why they have to share the risk. Most times what you get is you loan through an SPV. Again, I'll get into the reason for that when we move into the how. And considering that the upstream oil and gas industry takes a while to gestate, the tenors are usually medium term, between 5 to 9 years. Mostly 7 years, but between 5 to 9 years, you usually have a lot of financing playing in that space. Now, why do we have it? Why do we have to do project finance? The long-term growth of the industry depends on it. If you do not have a diversity of financing sources, to the extent that government is not willing to let go and government does not have money, you need to look for creative ways to fund the growth of the industry. And as our Nigerian oil companies and independent operators grow, because they don't have the depth of money that the IOCs have, they need to look for financing. So looking for financing becomes a very critical activity for them. And this is not just a Nigerian thing. One of the reasons why Shell is having issues is because their creditors are calling in. If you're a medium to small operator in the industry, you always need financing. These projects are very, very cost consuming. Now, who gets involved? NNPC, of course, they're the biggest stakeholders because they need it to invest in growth projects and increase production. As I mentioned, the Nigerian oil companies and independents would, that the financing helps them to bridge the gap between what their equity can provide and what is required to develop. Sometimes the IOCs also get involved to develop brown and greenfield projects. And then for contractors and traders, we're beginning to see more contractors and traders like Vitol, like Schlum get involved in stuff like this because it provides assurance of revenue for them. And then how does this work? Because this is more of a practical, discussion, I decided to have a slide to cover this especially. Okay, so the practicalities. First thing is when you want to do a project finance is to identify the project to be funded. One thing I would like to mention here is that when you're identifying a project, you are expected to have done your what you call a life cycle economics for economic evaluation for the project. So if you're going to do a project that's going to last for say 20 years, you need to be sure that the project returns enough value on especially when you discount it on a discounted cash flow basis approach, that you are going to be making a profit. And the reason why you need to do this is the banks are not really interested in life cycle. All they want is that will the project be robust enough to cover what they are borrowing the operator or the SPV for the period of the financing. So once you've identified the project to be funded, you set up a finance team. That usually takes a couple of months to identify the right advisors, legal, financial, and all of that. And then you structure the deal. It's 3 words on this slide, but experience has taught me that the devil is in the details. It takes on the average 12 to 18 months to structure a financing deal. If you get it shorter than that, it must be maybe a miracle, but generally it takes 12 to 18 months in the kind of industry and country we play in. You close the financing, and even after the financing has been closed and the money has been provided, there's a lot of effort that goes into monitoring and execution. And the reason for that is the first cocky dot I'm going to talk about. We call it a non-recourse financing or a reserves-based lending. It means that there's no collateral most times. So, I mean, imagine that you just got a marginal field and you want to develop for, say, $200 million to be able to do, say, 15,000 barrels a day for 20 years. Chances are that you won't have any collateral for the $200 million loan. So the risk is borne by the lenders. There's no recourse to whoever is borrowing. So because of that, there's a lot of rigorous financing documentation and covenants that lenders need or they require to protect themselves. And even when SPVs are used, you have situations where SPVs are most likely domiciled in Bahamas and they are just charitable trusts. There are no legal links to the people that are actually operating or borrowing the money. And that's not because you want to do anything underhand. It's just the way the legalities are structured. It's not peculiar to Nigeria. And it's not like people are trying to hide money, but you just want to do it in such a way that you avoid multiple tax in different jurisdictions. So because of this first 2 points where lenders don't get any collateral, you need to ensure that you have a lot of documents and covenants to protect lenders. In my experience, for the average financing, you sometimes have as many as 70 to 80 different distinct agreements. Now, part of that is that you have multiple consultants and advisors employed. You have the financial advisors that will help you bring the syndicate together, package what you call the information memorandum, which is like a prospectus that you use to go and approach lenders, organize road shows and meetings with lenders. You have the technical advisors or consultants who are independent and they act on behalf of the lenders, and their job is basically to say that this project is doable. You have the reserves consultants who tell you that the reserves are there, there's oil in the ground or there's gas in the ground that can bring money. One thing that's become increasingly important is environmental consultants. And you also have people that of course, you have to run a financial model to be sure that all the basics are covered. And most importantly, you have the legal folks, both local and international. Like I mentioned earlier when I was talking about structuring the deal, a typical financing takes about 12 to 18 months. It's actually very expensive. There are multiple travels involved. Well, pre-COVID, there were multiple travels involved. At the moment, I don't know how we're going to be doing that with the COVID restrictions in place. And because it's a non-recourse financing or reserves-based lending, there are multiple stress tests conducted by lenders to obtain their comfort on whether the deal is going to be bankable or not. So you want to test as many price scenarios as possible. Will this deal work in a $20 price scenario? Will it work at $15? If the production you told me you're going to give me is reduced by 40%, will I still be able to get my money back? If you don't execute as you promised and you are having delays by 1 or 2 years, will I still be covered? So basically, just to give yourself comfort as a lender, you do a lot of this, what's it called, stress tests. And sometimes you combine all of these stress tests into what you call a doomsday scenario and see if the project will still stand the financing test. Okay, I'm just going to quickly run through this slide just to give some kind of context into what we are talking about. Between 2013 and 2017, this is publicly available information. This is like a snapshot of the financings that have been done. Oando, for example, used their financing to acquire ConocoPhillips. Match Resources, which is now Midwestern Oil and Gas, used this for the Umusadege field development. Seplat used this for, not for a specific project, but for more bringing up all of their projects. So they didn't tie it to a specific project. Chevron and Shell used theirs for drilling. And typically, there's no straight rule to how many barrels a financing will cover. But if you're doing a 1 billion financing, you're expecting that you should be having millions and millions of barrels over multiple years, especially for a drilling campaign. So you drill and you expect that those wells will produce some very good volumes for 20 to 30 years. Okay. So moving on to my last slide, I think the format is that we're going to be taking questions. So I just want to talk through this, and then whatever questions you have, we can discuss in detail. Is that where are we at the moment, and what are the things I think we need to take away? The first thing is that, like every other industry in the world, with the exception of maybe Zoom and a couple of other technology companies, everybody is in a down cycle. At the moment, you cannot close any financing deal. There's too much uncertainty in the environment for lenders to take a risk on a loan that has no collateral. Currently, any financing that's still running, there's a possibility that they could be in default because of the current environment. Normally, you have what you call force majeure clauses, where due to act of God or an act that was out of your control, you could not meet your obligations, your debt service obligations, or whatever obligations you owe to the lenders. So we're in that kind of scenario now. I think the finance guys call it a black swan. Now, one other thing which I would like to focus on is that in my experience on financing, one thing that I know was a big issue for us that we had to get over was what we call country risk. A lot of lenders run away from Nigeria because they feel that the country risk is high, meaning that there's possibility that regulation might change midstream. There's possibility that your money can get stuck because of FX issues. There's Nigerian content issues that sometimes add more to the cost of doing projects. And because of that, there's a need for more involvement by Nigerian banks and advisors, because you see, once the deal is being domiciled, because one other thing to mention is that London is still the hub for Africa oil and gas finance. There's no way you can do a financing in sub-Saharan Africa without making multiple visits to London. The advisors are based there. The banks prefer to meet there. All of the consultants are there. And the lenders typically prefer London-based advisors to sign off on the project. So the Nigerian banks at the moment are still more like tag along, more like younger siblings to the foreign banks. And one of the biggest issues they have is that they are seriously hampered by FX supply issues. We don't have the depth for in-country advisors and consultants. This is something that comes with experience. The more deals they do, the more depth they build. We've come to a situation where we have a number of lawyers that have built a lot of depth, a number of financial advisors that can do the modeling in their sleep. But we still need a lot more. And the biggest takeaway is that until we can focus the hub of our banking and advisory services for project finance in country, the biggest issue we see, other than the global COVID issue that eventually hopefully will blow away, the Nigerian risk will continue to be a serious impediment to expanding the project finance space. So there's a need for us to build our expertise, both banks and lending capacity and advisory services, in order to grow the space. So that's what I have for now. I'm going to hand over to Emeka, who is going to take us through the midstream financing segment.
Okay, before Emeka comes in, just first of all, good evening, everybody. Thanks for coming on once again. I see a couple of you have started posting in questions. Please keep them coming. I'm going to curate all the questions, and at the end of the webinar, we'll be taking the questions one after the other. If the question is directed at any one particular presenter, do please just indicate that as well. Once again, thanks for taking time out this evening. Emeka, are you ready to go?
Yep.
All right, turn on your video so that people can see you, and let's get this rolling. Thank you.
You need to, okay. All right. Good evening, everyone. I'll really get to it. I'm here to talk about oil and gas financing, the downstream discourse. Midstream discourse. All right, my name is Emeka. I have 15 years experience in the investment banking space, emphasis on corporate and structured finance and advisory, spanning across the energy, oil and gas industry, hospitality, mining. But here we are talking about oil and gas in Nigeria. So I'm going to be discussing the midstream sector. First of all, midstream, we need to understand what the midstream sector stands for today, based on the definition or new definition out of the upstream sector. And we can understand that from the tax regime in Nigeria. Some of us can ask, okay, how about people who construct pipelines? How do you categorize them and all that? The simple thing here is you categorize who is midstream or upstream based on the tax regime in Nigeria. What do I mean by that? The royalty on crude oil, natural gas, and condensate for upstream companies is 85%. But companies that are defining themselves as midstream in the area of gas and thermal processes that produces domestic gas, condensate gas oil, and drilling fluid based on royalty of 30%, can say they are midstream. So their royalty, whatever they produce from the feedstock they have, is taxed 30%. So they are qualified as midstream companies by their assets, such as gas processing plants, thermal desorption units, and so on. Midstream activities are tied to the upstream sector in the area of crude lifting, using very large crude carriers, floating storage facilities, transportation using pipelines and flow stations, and that is contract-based. And then waste management, which is also contract-based for now. The largest pipeline construction ticket to date that I'm aware of, it's the 614 kilometers natural gas pipeline from Ajaokuta, Kaduna, Kano, with deal size of $2.8 billion under a PPP arrangement, build and transfer. It was awarded to Oilserv and Oando Consortium to do the phase 1 and 2. Then Brentex and China Petroleum Pipeline Bureau Consortium is handling the phase 3. And assets that can be created in the midstream sector includes gas processing plant. There is currently one in STEM. That's the 10 million standard cubic feet per day gas processing plant. That is, the deal size is $15 million. And there is a pipeline transportation of gas and PRMS station from the south-south to southeast, about over 200 kilometers. Deal size is $250 million. And there is oil waste management plants too that a couple of people have. And if you want to go into acquisition of very large crude carriers, you can get one between $43 to $120 million, and the other gas storage facilities. So financing structures available for these deals, they include asset finance facilities and cabotage finance, vessel finance facilities, currently managed by NIMASA and CBN. And there is EPC and contract financing facility and invoice discounting facility. But we're going to go straight to a case study that will give us a clear understanding of what the midstream is all about. It's about financing a 10 million standard cubic feet per day gas processing plant. Before we look at the value proposition, I need us to understand some basics, like the parties to the project. Company A is an upstream company with oil producing assets with associated gas. And then Mackenzie Energy Limited is a midstream company engaged in the operation of gas processing plants owned by oil producing companies. The company is the major sponsor for this project that we're looking at in the case study. And they are partners too. These are high net worth investors who are the minor sponsor to the project we're looking at. And there is a company called Safe Flames Limited. It's a special purpose vehicle sponsored by Mackenzie Energy and partners with equity ratio of 60 to 40 respectively. So let's look at the value proposition. Company A currently flares about 10 to 14 million standard cubic feet per day of rich associated gas from one of her field located onshore, accessible by very good motorable road. Then Company A is facing penalty from government for flaring right now. An experienced situation or an expensive situation, not desirable at all. So Company A wishes to monetize the associated gas. Now, a special purpose vehicle is to deploy a 10 million standard cubic feet per day LPG and condensate recovery gas processing plant and truck loading facility to Company A's location to monetize the gas. So the SPV has signed a 10-year flare wet gas processing agreement with Company A to process the 10 million standard cubic feet per day associated gas in order to recover LPG and stabilize condensate and also gasoline in that process. Now, the SPV will recover its investment by selling LPG directly to the domestic market and increase the energy security, reduce import and carbon emission, and split the stabilized condensate recovered from Company A to increase her crude exports from otherwise wasted gas. So the SPV will reduce Company A's liability from daily volume of gas fled and increase our revenue for condensate. Now, you look at the business model, it's about selling LPG, cooking gas directly to off-takers and stabilize condensate, which the oil producing, the company that owns the asset, the oil producing asset, will require in their E&P activity. So the gross revenue is there, the LPG looking at producing 55 metric tons of LPG on a daily basis with the price $300. And then you have $16,500 being made on a daily basis and the annual revenue. And then the condensate revenue to 235 barrels, you know, and coming at $12 per barrel, and, you know, the daily revenue coming in as well. So I won't bore you with the business model, but it includes total revenue, the expenses. We have the downtime of 10% being estimated, the OPEX, that's operating expenses associated with running this business, and then the finance cost for the lenders, and then it brings us to the total operating cost. So yearly net income during the first 5 years, it's about $2.4 million. And then yearly net income after 5 years is about $5 million or $5.2 million. Now, looking at the gas plant's total installed cost, you look at the capital expense, where you have the front-end engineering design and detailed engineering design with a cost attached to it. And there's a project management activity with a cost attached to it. And there's the supply of gas plant equipment, supply of inlets, AG compressors, supply of MCC, control room, caravan, and the rest of them, packing, truck loading, local fabrication, pre-commissioning and commissioning, 30 days of post-commissioning, plant operation and maintenance, there are costs attached to them. And so the total capital expense comes to about over $15 million. And we consider the risk management plan of the project risk management plan, and looking at the risk inherent in projects like this, installing a gas processing plant. You see, first of all, as a finance person, you look at currency risk. That is the risk associated with increased cost of capital, declining margins due to changes in the value of the local currency compared to the foreign currency, the value of the naira to dollars. And then the mitigation strategy includes hedging option, but they are not limited to repayment of loans, using the FCY cash flows from the sale of condensate. Condensates are sold in dollars. And so we ensure, and there's also the part of ensuring that service contracts for local currency denominated contracts are adequately maintained. So the LPG is priced according to the value of the imports, according to the dollar value of the imports. Like if you look at the benchmark for LPG, you can always give your local currency pricing on that. And then there's a technology risk, which is the risk associated with getting the right technology for converting natural gas to commercial gases. And there is risk associated with the suitability of the proposed technology for the project. So the mitigation strategy includes the engagement of the original equipment manufacturers to ensure that the technology and parts are available with process warranties. So using known technology, tried and tested technology, not new innovation of experiment. And this comes, these are warranties that we get from the OEMs. And the volumetric risk associated with that. The project might be impacted by the risk of not getting the required amount of natural gas. And this could be due to natural gas. But in this case, we all know that McKinsey has entered a strategic partnership with Company A to provide the required volume for at least 10 years. That's the agreement between McKinsey and partners with Company A. So currently, Company A flares 14 million standard cubic feet per day, but McKinsey is into agreement to process just 10 million. So the project delivery timeline, if you from the point of financial package to project kickoff, typically a deal like this shouldn't, the plans from the point of final investment decision to installation takes about 7 months to start. And then you look at the financing structure. The financing structure, in this case, the borrower is Safe Flames Limited. That's the SPV wholly owned by Mackenzie Energy and Partners. And the lender, in this case, is Afrexim Bank. The agent bank here is Sterling Bank PLC. The equipment amount, or the equity amounts, I beg your pardon, the equity amount is $3 million, equity provided by Mackenzie Energy and Partners. And then the purpose, the facility amount is $13 million, up to $13 million. Then the purpose is the procurement of gas plant equipment, procurement of balance of plant equipment, procurement of loading skid and storage. And then the term or the tenor is 72 months, inclusive of 12 months moratorium. The pricing includes interest rate, commitment fee, management fee. Scheduled repayment is quarterly repayment of principal and interest to commence after 12 months of moratorium with no interest recapitalized. Then the prepayment on principal is allowed. Security is also on the pledge of cash flow and mortgage on the asset being financed by the lender. And then we have the warranty agreement, debt service reserve account, major maintenance reserve, interest rate protection, FX, independent engineer and governing law. These are covenants that I didn't want to share them here because this transaction is live. But these are covenants that every borrower enters with the lender. So you have covenants that protects the lender's cash in the project at every point in time. So finally, I'll go to economic realities. Project finance is very much closing up for Nigerian banks because of their balance sheet size and structure. I don't think it's trending down with the Nigerian banks based on their balance sheet size and structure. And our country risk, Nigeria's country risk in this case, also reduces the option of project financing. For the first-class global banks, our country risk is a big issue now, and I think Dio mentioned that earlier. So we have banks like the Bank of Industry, NIMASA, and the Central Bank of Nigeria. They are open to assets financing for vessels, gas processing plants, and tanker trucks, provided they are tied to contracts. That brings us back to the contracting with NNPC, IOCs, or any off-taker assessed to be in good credit stand with the bank. Afrexim Bank is open to project finance transactions in addition to asset finance for projects tied to a term contract, still back to the contracting, with counterparties assessed to be in good credit stand with the bank. Nigerian banks can fund midstream businesses because the deal sizes are not that, huge. A $15 million transaction here, $20, $30, $40 million for gas processing plants, thermal desorption units, where you also produce condensate, gas oil, kerosene, drilling fluids, and all of that. But all of these things should also be tied to contracts with counterparties, or with counterparties with good credit stand. I think I'll hand over to Diron at this point to take it from there. Thank you for listening.
Okay. Hi, Diron. Are you ready to start? Okay. All right. So, Diron, you take it from here. All right. I'm gonna mute myself now. Thank you.
Can you hear me?
Yep.
Yes, we can hear you.
Okay, so just a sec for the slideshow. Can you see my slides?
Yep. Go ahead.
Okay, so good evening, everyone. My name is Diron. I am a banker. I actually work in Lagos in Nigeria here. I work with FSDH Merchant Bank, where my responsibility is for the energy portfolio in terms of relationship management, debt financing, and other forms of financial services to the energy sector. Today, I'll be talking about financing oil and gas in the downstream. Mine is probably a different twist to the presentation made by Emeka and Dio. I will deviate a bit from project financing as seen in the upstream and the midstream, and talk a bit more about the downstream from a distribution and a marketing perspective, and I'm saying trading essentially. So looking at the downstream structure in the country, it's not too different from what you have in the major countries that are producing hydrocarbons in the world. Probably the only difference that I would mention is the fact that we rely a lot on imports. So what that means is that we're now focused on refineries outside of Nigeria. Now, in addition to that, you have primary and secondary distribution and transmission, which evolves in form of storage, pipelines, and predominantly road tankers, which is what products are moved by locally here. When we take a dive to, sorry, yeah, so when we lift the veil to look at the players within the industry, at the very top, you have the regulators. This are the party that's saddled with the responsibility of forming the policies, the implementation, supervision of the operators in terms of ensuring that they follow the petroleum laws and regulation of the country. The next line you have are the suppliers who, it's basically concentrated with the international commodities traders. Now, these international commodities traders partner with the importers. These importers are either the NNPCs through the pipeline and product marketing company, a subsidiary of the NNPC, or bulk traders. Now, the reality in the country is that the core of the products that are coming in are imported by the NNPC, and I would explain this further as I go into the presentation. But of course, as the product is imported, it then moves to the storage operators who are also traders and marketers under the umbrella that's of the association called DAPMAN. That means the Depot and Petroleum Product Marketers Association of Nigeria, and who work closely with the Transport Association, the road tankers operators, and then move the product to the marketers. Now, these marketers are retailers, and they essentially are the operators of the fuel stations and the fuel pumps that you have across the country. And they are segmented into three parts. You have the major marketers that are popularly called the Big Six. Historically, these were companies that were owned by foreigners, but different acquisition and mergers have happened. That it's mostly locals that are the owners of these companies right now. But of course, a major part of the players is centered around the independent marketers. About 10 years ago, there were 5,000 operators within the independent marketers. My guess is as good as yours of how big that subsector of the downstream is right now. And of course, the NNPC retail is also a subsidiary of the NNPC, and they have pockets of retail stations spread across the country. So just quickly look at some industry facts and updates of the downstream. When you look at the products, there are various kind of petroleum distillates that are supplied into locally in Nigeria here. But the beauty of it actually is the fact that three products actually controls 96% of the entire demand in the country. And these products are gasoline, which is popularly called petrol here in Nigeria, diesel, and jet fuel. And a closer look shows you that 76% of the demand is actually just gasoline. What that tells you immediately that the downstream is a gasoline play. And gasoline plays a major part in what is happening in that sector. And when we look at the total size, gasoline alone, based on revenue from the marketers, is almost about $10 billion. When you look at the whole industry, that puts about $13 billion in turnover that this marketers made in 2019. There's a relatively low barrier of entry with investments in marketing infrastructure, separating the fringe players from the major players. And of course, like I mentioned earlier, we are heavily dependent on importation of petroleum products. 94% of the product that came into this country last year, or rather the entire supply to this sector last year, 94% was imports, while 6% was from the refineries. But that said, it's not all gloomy. We all know about the Dangote refineries and petrochemical plants that's supposed to bring about 650,000 barrels per day in production capacity when it's completed, say in another 2 years. And that will be a game changer that it's believed that will turn Nigeria to a net exporter of refined products. And of course, apart from the 4, or should I say 3 refineries that are producing when they can right now, there's some form of modular refinery capacity that exists as well. And there's a lot of projects in terms of modular refinery ongoing right now. One thing I want to say at this point is, I mentioned earlier that in terms of importation, it is centered around the PPMC. It's not like there's a law that says that it's the government agencies that should bring majority of the product. It's just how things have played out in recent years. And what has happened is because the PPPRA, which regulates the price of gasoline, has set a price which it has to be sold. What that essentially does is that when importers bring products into the country, it lands at a cost that is higher than the price they're supposed to sell it, which means the government is supposed to pay subsidy. Now, this subsidy has been quite controversial in the last 5 or 7 years, and that's because the government has not paid as and when due, and that has created a big problem for the importers because these products are financed by banks and they are unable to pay. As a result of that, they had to push back and refuse to import gasoline into the country anymore. And of course, we're talking about a country with over 200 million people population-wise, and they still need gasoline. As such, PPMC took it upon themselves to be a sole importer of petroleum products, gasoline into the country. But that said, there was a recent announcement by PPRA that the cap on per liter sales of gasoline has now been lifted, and that it's now possible to sell at the price you can. Well, before everybody shouts that, okay, that's good, things can move forward, the reality is that it's some form of guided deregulation that is happening, because the PPRA from time to time will still give a band which the price should be. And this is still not acceptable to the operators, and they're clamoring for full deregulation of that sector. So, to the topic of finance, first I'm looking at where the source of finance, which can easily be gotten locally here in Nigeria. And I've sort of scaled the operators on 3 levels, small scale, medium to corporates. And this tiering is based on the level of trade that they would essentially do, which I've also looked at below $1 million to well above $20 million for the corporates. Now, for the small scale, ideally, where they should source the products, source for financing, it should be not the bank, but actually looking at family and friends, angel investors, and other sources. And the reason why this is my view is because when you look at the margins, which you will see in the next slide that I'm going to present, when you look at the margins in trading locally, they're very thin. And the cost of finance is quite high. And the combination of this and probably the fact that it's quite expensive doing business in Nigeria makes it extremely difficult for this small scale to grow. And of course, between the medium and the corporates, they can easily get financing from the bank based on their, depending on their capacity. And this finance will be provided to them in form of trade finance, which would they would get in form of an import finance facility or a local purchase facility. For the corporates, for the very major corporates that are as big as the blue chips, they can extend that by floating the commercial papers. A commercial paper essentially is a money market instrument that allows a large corporate to access short-term funding. And they can extend that for a longer period by also floating a corporate bond. And of course, by virtue of their size, they could get the cost of financing a bit lower. In looking at the finance requirements for the downstream, I have 9 requirements on the slides. This is not exhaustive, but in fact, the first 3 is not, concentrated mainly on the downstream, because any credit, be it in the oil and gas or other sectors, would also require that you know the promoters that are asking for facility, that you understand that the managers that are being put in the business are competent. And of course, with regards to capacity, a small-scale company cannot approach a bank and want you to finance something that a major corporate will do. But what is key is that in financing the downstream, which really is trading, is you look at the market risk. And when I say market risk, what I am saying is that you actually have to have an analysis done where you ask critical questions and say, where are you sourcing this product from? Are you buying locally? What is the price? Is it a fixed price or floating price? If you're importing, which is mostly a floating price, what is the price index in which it has been benchmarked? You also look at the other side of it in how the product is going to be sold. And then you ask the critical questions of who is taking this product from you, or are you selling at open markets? And then you also look at price in terms of what is the market price doing. Now, when you look at the two sides of this, a financier wants to know the margins that is being projected. And of course, a profitability projection is done. And the margins, which you would find out in a case study that I'm going to show shortly, are very thin, which means it's easy to actually come out with losses. And part of the things I would also show is that there's certain things the banks would ask for to ensure that their own position are covered. Now, just to move further, when we look at foreign exchange in a country like ours, right now it's a bit scarce getting foreign exchange to finance your imports, and it's not just solely to the downstream. For Nigeria, we depend on the oil sector for over 80% of our foreign exchange. And of course, when you have the kind of shock that we've had, or that the world has had in the last 2 months, with regards to the impact of COVID-19, which has affected the oil sector and brought the oil price down, essentially it becomes difficult to source foreign exchange. As a financier, you basically ask the question, where are you sourcing foreign exchange from? And without a good answer, there's no deal, essentially. The next one, which is the value chain play. What I mean here, and this reminds me of a saying, when people say, what you lose on the swing, you gain, you make up on the roundabout. And what that simply means is that, where are you playing in the value chain of the downstream? It is possible for you to have a vessel, and in this case, a daughter vessel, or how people call it, a shuttle vessel, that lifts product from a mother vessel that's bringing product, let's say, from Europe. That might belong to a trader. In addition to that, the trader also owns the storage, probably owns the trucks that are going to transport it to the retailing stations. Doesn't necessarily need to, own the entire value chain. But what this means is that if price crash at the tank farm, you still make money from the fact that you use your vessel. You still make money from storage. You still make money from transport. You still make money from the retail end of the value chain. This is quite attractive to financiers because those pockets of margins that you make can actually be the saving grace. But of course, it's a regulated industry. You need to ensure that the regulatory requirements are done. Sales collection strategy only means that most banks will structure the facility in a way that the end user are paying directly to the bank. So if a bulk trader is buying product from a storage, for example, you would have to pay upfront before you lift the product, which is popularly called cash and carry here in Nigeria. And of course, the logistics is key. How are you going to get a vessel? Do you have the vessel? Do you have a truck that will move it and everything? And of course, petroleum products, given its nature and the effect on the environment, you need to ensure that the borrower has done all that is needed. The next thing I want to do is just to quickly look at a case study, and I'm getting to the end of this presentation. And I'm looking closely at the marketing analysis. Earlier I discussed where do you source the product from and how do you get it out, what price at both ends. So this is a fictitious case of a company called Petroco Africa. It's a mid-sized company, owns retail station storage, and has approached a financier locally to say, I want to import 10,000 metric tons of diesel. And basically, he has a contract to buy from a reputable name based in the Netherlands. And he plans to sell 95% of that product as bulk sales from his own storage facility. And in addition to that, between the financier and this borrower, they agreed that 90 days is enough for him to come out of the trade, essentially, and repay the bank. Now, without going through every single line of this profitability projection that I have on the slides, essentially the cost of this product to the supplier is about $4 million. Now, when you convert that at a rate of 388, and I'm not saying this is the current rate in the market, you have almost 1.6 billion that this client needs. When you have the operating expense and the finance cost, it takes it to almost 1.7 billion. Essentially, when he sells it from storage at about 148 naira per liter, he makes just 2 naira 87 kobo. Now, because he's selling 5% of that product from the retail station, he can make an additional 8.7 million naira, which takes his whole return to about 42 million naira. Now, when you look on the right side of that 42 million naira, you see that the entire margin that is made is just 3 naira 62 kobo on every liter sold. This is quite thin. And thin to the fact that if anything happens to that selling price of 148, say it dips a bit by, say, 4 naira, you're in a hole. And this is why the financier needs to take a critical look at the margin. And one of the things that the banks will do in this case is to say, you will bring what is popularly known as equity contribution into the transaction. And that equity contribution could be 10%, which means even if price drops, the bank is protected. So a lot of clients locally here always frown against that requirement from banks when they say you have to bring equity contribution. But at the end of the day, it boils down to capacity. If you're a major corporate, such as the major six that I mentioned earlier, financiers will not ask for that requirement for them because they know they have a lot of trades going on and they have businesses across the value chain that can always repay. The last slide I have is the terms and conditions which will now be agreed with the borrower. If you've agreed that you will go ahead, this is just a summary of part of what forms what is called an offer letter. The facility is a trade finance line, $4 million just to cover what needs to be paid to the supplier. It's part finance because we will require equity contribution, say 10 to 20%. And of course, I mentioned earlier that this trade will basically take about 90 days. But because I see that this company has a bit of capacity in terms of ownership of storage and retail station, I can as well decide and say, you know what, I'll give you this facility for 1 year. But every time you draw it, you must pay me back within 90 days. The interest rate depends on the cost of finance for the financier and also their assessment of the risk inherent in the transaction. And the security will ideally be a domiciliation of the proceeds. As a financier, I could hire a consultant who will work as a monitoring agent to ensure that what I have agreed with the borrower is what happens. And essentially, product moves from A to B as agreed. And if there's any problem, I'm the first to know. And of course, there's insurance to protect the logistics risks that I mentioned earlier. Other securities that you could possibly have includes mortgage and charges on other assets, a bank guarantee, and negative pledge. What negative pledge means is, and this is directed at the corporate, is I can do this transaction for you at no security because you have capacity and I trust you because you have the good reputation. However, the assets you have, you will not give them out as security unless I give a go-ahead, or maybe I need to be notified before you do that. So I hope I've been able to give you a bit of what goes on in the mind of financiers when they're looking at the downstream. Thank you very much. So I take you back to KK and Debola.
Okay, thank you, Diro. Thanks for that. That was very engaging. I think I particularly, if I speak for myself, I just like seeing dollar signs because it just paints a picture of the margins that most of these companies are actually dealing with. I think one of the reasons why we decided to pick this particular topic to discuss on our webinar is there's a huge misconception out there that there's excess cash flow in the industry. And maybe there is. Perhaps it's not a misconception. Perhaps there is. But however, what we've constantly been observing over the course of the years is the margins are getting slimmer and slimmer. And more importantly, now than ever, Sub-Saharan Africa, and in particular Nigeria, we need to be able to create enabling environments for business to be able to thrive. You can't stress this, you can't overemphasize this point. So yeah, beautiful presentation, guys. We're getting lots of questions coming in. So we're just going to jump into the Q&A session straight away. So I'm going to share my screen. I've put a couple of the questions together, and it's the ones that are directed at any one particular individual. He can pick it up, but I'll just read first two questions, and then I'll decide on who's going to pick it up. So just give me a sec. I'm just going to share my screen now. All of a sudden, I've forgotten how to share my screen. Okay, now that's just plain. Here we go. Okay, so what happened was when we sent this invite out, we actually got a couple of questions from some individuals that told us they couldn't make today's session. So some of their questions are also on the screen. So first one comes from Akume. And I guess this applies to all the presenters. So we're going to take this from Dio. So the question is, where are the opportunities in the bottleneck? So I don't think this reads well. Okay, I guess the question, what he's trying to find out essentially is, where are the particular bottlenecks? So for instance, the way we're going to answer this, Dio, you come in first. Just highlight maybe one or two bottlenecks that you feel are the more consistent bottlenecks as far as the upstream is concerned. Then Emeka will come through and talk about the bottlenecks or possible bottlenecks or common bottlenecks in the midstream. And equally, Diron will come in and close that out as well. I hope that's very straightforward. So Dio, you take it first.
Okay. So really, from an upstream perspective, when the biggest bottleneck we have is country risk. Because of the nature of the upstream, where you are usually looking for a lot of money. The last deal I worked on was for almost $1 billion. And if you look at the charts, a lot of those deals were in serious amounts, dollar terms. So the bulk of the lenders are from outside Nigeria. And I've sat in the room with lenders, and the first question or the first hurdle they usually have to get through is country risk. And I've had lenders walk away from deals because for them, their credit committee just cannot deal with the country risk. That's the biggest one. And that country risk encapsulates almost everything that is wrong with the industry, whether you're operating there or you're trying to raise finance. Security issues, you can call it force majeure because your pipeline was blown. Those are not things that are used to in Europe or in North America. Regulatory changes. I joined the industry in 2008, and when I joined the industry, the first thing I worked on was PIB interpretation. And this is 2020, 12 years later, and there's still no version of the PIB that we know is going to pass. So when you have those kind of situations, and then you increasingly have a government that is looking for fiscal grabs here and there, and so basically it just looks like the country is not really ready for business. And that is the biggest bottleneck. And when you talk about opportunities, I think the biggest opportunity we have in the upstream is the kind of resource base we have. My employers always say that the resource base in Nigeria is mad. I was on a trip to Angola and I spoke to a driller. And it was like when he came to Nigeria and he heard that a well produces 3,000 barrels in a day, he actually thought that it was a typographical error until he literally strike oil and it's gushing for years. So the resource base is fantastic, but the above ground risks in terms of the regulatory environment and the country risk just make it very difficult to finance.
Okay, so thanks for that, Dio. Emeka, do you want to take the possible bottlenecks for the midstream?
Yeah, I would join two questions here: the bottlenecks and a question asked by Ahmed. You mentioned talking about if risks are eliminated, if all the deals are structured in local currency, while aren't the local banks participating in more deals, like taking advantage of this opportunity? You know, I mentioned the realities. Number one, the reason why banks are not funding deal sizes like this, it's their balance sheets. Most of the deposits that come to the banks or that the banks go out to market from high net worth individuals or from pension funds or from investment houses and all of that are short-term based. Nobody places money with the bank more than a year. They shop for interest. Today, you want your money to be in GTB, and you hear that the Sterling Bank is giving an interest of 13%. You move your money from there. So, in managing a balance sheet, if you have a deposit base that is short term, and people are coming to you with projects that are 5 to 7 years based, it might be very difficult for you to finance. It's a bottleneck in the midstream sector because projects are not like downstream where you have 90 days revolving cycle and it's always a letter of credit based and guarantees and all that, maybe back end, like not a direct cash disbursement. But in this case, you're doing a project that requires installation, construction period, and then especially when somebody comes with a project that is not close-ended. What do I mean by close-ended? You have a project that is not tied to a contract, that is short-term between 3 to 5 years to the bank. They can accept that. It's a very big issue for them. It's difficult for them to come through for you in that case. So we hope that banks are able to change or like find a way to restructure their balance sheet and also market more of long-term loans. And if pension funds that is very huge in Nigeria can actually extend and don't shop in terms of moving from one bank to another, I think Nigerian banks can come in play. Most of them are strong today in trade because they have a lot of correspondent banks like foreign banks backing them with their confirmation lines and all. That's why it's easy on that side. And I think they also mentioned the fact that FX is a big issue. Reason is it's very difficult for them, even in CBN, it's difficult to access foreign exchange to close import deals. So I think I'll really emphasize on the fact that the balance sheet structure of the bank is a big bottleneck for investment in Nigeria. Thank you.
On my part, can you hear me?
Yeah, go ahead.
Yeah. So on my part, I would look at the opportunities and the bottlenecks separate, and not necessarily say that what are the opportunities within the bottleneck, because what can you do with the challenge of regulation in the terms that the product that is in highest demand is regulated. If you've been following what has been happening in the country in recent years, diesel was once regulated as well, but then released, and it's thriving now, and that creates it's created a lot of opportunity for investors to come in and make some form of good margins. So for me, in terms of the bottlenecks, I tap into a lot of what was just said by the two panelists in terms of regulation. If we can get to a point for the downstream where regulation can be eased, it will go a long way. While FX, like Emeka said, is also a major concern, but it's not going away anytime soon until when Nigeria, sort of straightening out itself. But in terms of opportunity, I think there's a lot of opportunity within the downstream, even though I said there's a low barrier of entry. When you look at the modular refineries, if you have time, you can always go on the DPR site and see the type of licenses that are being granted. You don't need the kind of money that Dangote is using to build a refinery. And the kind of money that you need can easily mean that you would basically uncouple a modular refinery in Europe and just ship it down to Nigeria and couple it back. And with that, depending on where you site it, and depending on that location to the source of crude, you could essentially start making the kind of money that, depending on the kind of investment objective that you have. And there are other opportunities as well that are, coming up with regards to retailing, LPG, and some other sectors too. So those are my thoughts.
Thanks, Diron, for that really comprehensive response. So I've got a couple of questions I'm going to combine now, and I'll direct them your way, Emeka. So the first aspect of the question is for downstream. This is from Adeyemi. For downstream, what is the effect of the recent cap removal of PMS price for downstream traders? If you have any thoughts on that, and how will Dangote refinery coming online change the downstream gasoline trade? So Duron, you might also have a few thoughts on that, but I just wanted to make out to keep that a go.
Okay. I'd like to be very strict on this. I think government is not being sincere on PMS pricing in Nigeria. When President Muhammadu Buhari took over in 2015, I think there was a fall in oil price, and it also affected white products. And now, in order to score a political point, he told us, or the Minister of Petroleum then said, that there hasn't been subsidy. And Nigerians were not asking questions based on the benchmark of white products in the international market, from Reuters, Platts, or from ICE. And they were just busy saying, yeah, that there was a subsidy scam and the rest of them. And they told us that there was no subsidy and scored a political point based on the price, the downside of the price at that point. Now it's happening again this year because of COVID, crash in crude oil price. It affected white products. Jet fuel went as low as $140 per ton. PMS went as low as $194 per ton. AGO went as low as almost $200 per ton. Now, it was a good time for government because people started talking to say, look, we can't be buying fuel at $145 from the filling station when we already know. The people that monitor market, they were like, we already know that this is what it is. And then government announced a reduction, 10 naira, and also announced again that subsidy has been removed. The subsidy cap has been removed. Now, if they actually want to be sincere, Nigerians need to know this. There's always a rise in price of petroleum product, and there could be a windfall. So right now, they have not removed subsidy as the case may be. Some traders capitalized on the removal, traders that had cash to trade, to take a position. They brought in PMS and made good money. Now they can't touch PMS because prices are going up again. And we have foreign exchange challenges with banks and CBN and all of that. Now prices are going up again. And when they do, government will have to, NNPC has a way of taking the subsidy from source, but they won't tell us. So I would not advise any trader. There is still a bottleneck. PMS has not been fully deregulated. I don't know Diron's view on this, but I think it has not, sincerely speaking. They have not done anything to that effect. Now we are enjoying it because prices are low, but prices are picking up now, and they will actually go up. And when we have that challenge, and you hear that dollar is doing 430 in a trade, trust me, if government says there's no subsidy, you are going to buy fuel for 250 naira per liter. You will do that. And if that happens, of course, if we don't learn from, I think we also missed it when President Jonathan in 2012 decided to remove. So I wish we adhered to that. By now, we would have adjusted properly. But for me, subsidy hasn't been removed, and I won't advise any trader to go into it until you need to watch the market. What we are enjoying today is the stock from NNPC. NNPC has a lot of stock now, and maybe when the bottom out of stock, let's see what happens. But for now, no. The second question is that I need to talk. Dangote refinery, I really don't think, this is my honest opinion, I don't think it will have any effect to our pricing of petroleum products in Nigeria. Dangote's refinery, if you look at the process flow, is going to be bringing in crude outside Nigeria, not necessarily Bonny Light or something. And he has, I think he's moved his upside of his investment to petrochemical. So he will not, it's not in any way going to maybe vessel pricing, like in terms of bringing product from Europe, the what they call it, the premium on bringing products from Europe might go away, but Dangote is going to price this product on Reuters flat and ice. There's no subsidy coming from him. He's going to do that. Yes, he will have a lot of foreign exchange inflow, but let's see if he's going to give it back to CBN at official rate, or he's going to play in the black market or IMU window. Thank you.
So my view, my first comment is, I can't say it better than what Emeka has said. In fact, I was going to ask if he's a trader, because the passion with which he said it, it was as if you were hearing from the horse's mouth. So, but what I just want to add to that is that the recent announcement by the PPPRA, on one hand, that is now fully deregulated and that the cap has been taken off, was quite confusing. At least was confusing for me, because on one hand you said you removed the cap, while on the other hand, what you're doing is to say, oh, but there's a band which you can sell. At the end of the day, it doesn't work that way. In putting my presentation together, I mean, I had said that the product with the highest demand was gasoline. So it only made sense that I made a presentation based on gasoline. However, adding the numbers together, as in putting the projections together, didn't make sense, which is why people are not importing products. You understand what I'm saying? And with regards to Dangote and if it would affect price, I have the same view as Emeka. Dangote is a businessman. The same way it's been, you would have petroleum products trading on Plat or ICE, it's the same way it would also form a market and be selling. The only difference is that if you look at what the presentation I made, the part of the profitability projection, there was a part that said, this is the price of AGO, this is freight. So freight would probably not play a part. So you have a situation where the local retailers would just send their trucks to the petrochemical plants, or you have a situation where the tank farm owners will buy and store. So people will keep going to the tank farm to buy products. So it's not going to be so much difference.
Great. Thanks a lot, Emeka and Duran, for those really comprehensive answers. If Dayo, I'd like to direct the next two questions at you, and
Okay.
they're primarily upstream related questions. So the first question from Yinka was, he or she is trying to understand how Tolo managed to build their portfolio so rapidly pre-COVID, and whether the same model could be reciprocated by a sub-Saharan African-based company. And the second aspect would be from Yemi O, who asks, as far as is known, are there any finance impacts to already sanctioned projects, such as NLNG Train 7?
Okay, so let me take the second question. Like I said in my slide, it'll be hard to close any financing. On LNG, I don't have any specific information, but it also depends on what the long-term outlook and the risk profile that the banks had given LNG at the time they were closing the deal. Now, LNG has a long history of operating, and they've been successfully operating. So it means that their risk profile to lenders should be much, much lower than it would be for a normal borrower. And if that's the case and the deal had already been sanctioned, that means it's legal already. They are just not drawn down. It will be difficult to stop it from going ahead, especially if LNG still intends to FID at the time they do. If they don't FID when they had promised to, then it might then give an opportunity for the banks to pull out. But at the moment, there's no news to the contrary. And I think I had a chat with the guys a couple of days ago that the LNG deal was not one that was heavily marketed in public like you would do for most of the deals are usually done in private until they are signed. So unless there is a serious issue in terms of LNG not getting to FID or the risk profile going significantly high, then it should go through, but we would know with time. The thing is, any deal that was in the works that had not been signed off, chances are that the banks will say, let's wait or do further stress tests. So if they do further if they do further stress tests and they find that the deal can still work with the much lower price scenarios, then they'll go ahead because they also need to make money. Now, looking at Tulo, so Tulo is one of those companies that decided that they were going to expand by buying aggressively a lot of assets. Jury is still out as to whether it's a very successful strategy or if it's better to grow organically, because the thing with growth by acquisition is sometimes you overpay for assets. Now, I know Tulo had to go and raise another 750 million in 2017 when oil prices, after the 2016 oil price crash, meaning that they were already out of pocket because of the acquisitions they had made. Now, since then, I don't think they've gone to the market. The problem with strategies like Tulo is that in a rapidly up and down market, zigzag market that we've had over the past 10 years, I think this is the third oil price crash in 10 years. It becomes increasingly difficult to know what the right value is for assets. So chances are that you would overpay for an asset. And I'll give you a good example in Nigeria. Oando paid for Konoko, or they acquired Konoko just before the oil price crash. Now, if they had waited a few more months, they would have been buying Konoko at a much lower price. And that is the biggest challenge with Tulo strategy. You need to know the right time to buy. Another one is the Occidental and Anadaco, where they purchased, and Occidental decided to use Tulo strategy of basically overpaying for an asset, and even Chevron had to back out of the deal, or if it's the other way around, and even Chevron had to back out of the deal. The problem with stuff like that is that you end up buying the assets, but you are buying an asset that will not return the value and eventually chips into your own company value. There's a company that I reviewed a couple of years ago, Afren. They had a similar problem. They bought, so the Afren was operating in Nigeria, making good money, a couple of fields, and they decided to do the strategy Tulo does and went into Kurdistan to acquire a couple of assets, and then ISIS came, and that deal went sour, and that's it. Our friend did not survive it. So it's a very risky strategy. If it pays off, there's good upside, but in the market we're in now with an oversupply, the risk of paying too much for an asset is one that's probably too high to take, at least from a finance perspective.
Excellent. Thanks a lot for that, Dio. And I think just to mention on the Tulo case, so the share price 5 years ago was about 400 pence or £4, and today they're trading at 30p. So just to give you a bit more of an insight, it may look good at the time, but you know, there's heavy costs when things go wrong. So I'll just quickly move on to a few more questions in here. There's one, I think, two, which I'll direct at you, Diro. So one was around, you've shed light on issues for the downstream aspect of the industry. What are the key barriers? So now, having noted the barriers to entry the downstream industry is low, which part of the value chain you discussed earlier, product supplies, transportation, or marketing, would you say is the easiest to answer? And just to tag on to that, there's a question from Educate, which is asking around profitability. Is there a minimum margin on trading petroleum products that will encourage access to bank borrowing, or would an investor have to have been in the business for a while before requesting a bank loan? He also follows up saying that there's a lot of portfolio traders who just want to cash out quickly by taking advantage of a low barrier of entry. How would you mitigate against trading risk?
Quite a lot of questions to answer. I hope I don't mix it up. But let me start with the second question, which is the question with regards to margins. I wouldn't say there's a particular margin that is, I can't say this is the margin that you need to successfully trade that will be acceptable to a bank. Your guess is as good as mine that you will know if a profit margin is significant enough, because and that will come from when the banker starts telling you if equity contribution has to be provided on the table. But with regards to I think his question said something about what I'm trying to open the questions actually. Hold on. AGK, you said, right?
Yes. So there's a question around, what I think there's two aspects: the minimum level of profitability, and second is how would you mitigate against trading risk, especially with portfolio traders who want to cash in quickly or cash out quickly by taking advantage of low barrier of entry?
Well, I don't understand what that means when you say quickly want to cash in, because it's either you're in or you're out. And if you're a French player, yeah, market may play to your advantage as a broker, whether you make money. And like I said earlier, you can't put and say this is an adequate margin. And the financier would essentially tell you that, no, this is too low. The example that I painted earlier had under 4 naira per liter margin. That, depending on the size of the company, may fly. However, depending on the size, say a medium-sized company without any infrastructure, and if everything goes belly up, where market price drops, there is nothing that the company can do. This is where the bank will now decide that, you know what, you have to bring some level of equity contribution here. I don't know if I answered the question. There was a question around where the opportunities are, right? Within the downstream. And earlier, in adding to what Emeka had said, I explained that there are opportunities in the downstream. Everything boils down to the pocket size of the person that is looking to come into the industry. If you have very deep pockets, and depending on your experience, it would be good to go into the part of the downstream where you can set yourself apart from the marginal players, where you actually invest in infrastructure. And some of those low-hanging fruits, if you leave out the refinery, the modular refinery that I mentioned earlier, is within the LPG space. There are very big players that what they're doing right now is aggregating LPG tank skids. What this means is that when you go to a station, you see a very small tank that they actually dispense liquefied petroleum gas into cylinders. Now, what this means is that with the increase in the demand for LPG, which has taken kerosene down, what you have is that almost everybody is now using LPG. Use of firewoods or using kerosene has gone down significantly. And what that means is that there's a lot of opportunity in the LPG. Very big players are looking at that sector. So depending on the kind of money you have, it's something that you could look at, because this is in terms of storage and dispensing. Is there any other questions? Portfolio entry. Yeah. Is there any question I've not answered?
I think we'll keep swapping around. There's a question directed at Emeka here, and it says, considering what is happening today with respect to prices and IOCs trying to reduce their OPEX, we observe that IOCs are engaging contractors to negotiate reductions in rates. So for vessel finance transactions, where the banks would have parted with huge sums trusting available contracts would repay the loan, how can a financing bank protect itself today from similar risk exposure in the future? And secondly, there was a second part to that question, which is, what are the major operations risks associated with running a gas plant? Emeka, you just need to come off mute. Yeah.
Okay. Regarding the first question on the IOCs reviewing the pricing on, I guess, payments on the usage of vessels deployed to their fields offshore. So now, if you're in that situation, because I know for you to get into contracts of, such, you will require, I would advise, because there was a time Afrexim Bank and Nimasa set out over $15 billion for, not 15, $1.5 billion, I beg your pardon, for cabotage vessel finance facility. And some people took advantage of that opportunity. Single digit interest rates, not something very commercial like we see these days. And then their receivables were also in dollars, because I know, as far as I'm concerned, under UCP and also shipping law, I think receivables globally are always in foreign currency. So if you're in a situation where your counterparty or like the principal says, I cannot afford to pay this, considering the fact that income level is not this, I may have to revoke, or we have to, get into some litigation and all of that. You're running at a risk of repaying your loan with the bank, and also the risk of deploying same vessel to probably another field. I would advise that you engage your bank for restructuring. That is always open to any wise bank, not to go into litigation. I mean, it can always be restructured. If you have a 7-year loan or 5-year loan, you can always restructure to accommodate your repayment plan. So if you are found in that situation, I would not advise that you fight your principals or like you go into litigation or arbitration. Find a way to get restructuring from your bank and adjust your cash flow model. That's my answer. Then the second question, I didn't get that. Debola, can you take me through the second question? Debola.
Yeah, so the second part was, what are the major operations risks associated with running a gas plant? So I think it's referring to your case study about the gas plant.
Yeah, we looked at technology risk. Of course, we all know safety and all of technology risk is very key. You cannot operate a gas processing plant with a technology that is not proven. You need their gas processing plant manufacturers in the US that are known and tested. And so you get your, I think once that it's put in place with the right manpower, you to some extent, you have eliminated operational risk in running a gas processing plant.
Great, thank you a lot for that response. There's a question for, I would say, directed at our banker. How long will we have to wait for Nigerian banks to be in a good position to solely finance major oil and gas projects? Can they afford to give long-term loans at low interest rates, considering the desire for very short-term loans at high interest rates? Please don't, I don't think it's personally directed at you, I'm sure you don't, you're not oriented that way, but it'd be good to get your views.
I think it's directed at Jerome.
Maybe from personal experience, I can't say.
well, my views are as follows. When somebody asks for cheap financing, the first question you need to look at is, what is the structure of the cost where to the banks in the Nigeria right now? Essentially, the cost of finance is high, and the kind of finance that the banks can access is not, they're not long-term financing the way most the way the question has been couched. So the reality is that you can only make available what you have. You won't find a bank giving you a 15-year loan unless they can access that kind of loan. Don't forget that banks are intermediaries. You take money from one end and give to the other. And you have to make sure that you're matching it appropriately. You can't give a 30-day deposit to someone that needs to use it for 5 years. So the reality we have is that the source of finance and the structure of its cost is why it is what it is. Now, to the question of if banks can single-handedly finance projects, I believe banks, the way banks have been capitalized right now, banks can actually single-handedly finance projects. But is that the ideal thing to do? The kind of financing you need mostly in upstream and the midstream are quite large. And even if a bank can take that on their own, on their balance sheet, it's not advisable. And what you find in Nigeria now is one or two banks come together to finance the deal because it allows them to manage the risk, essentially. So, but of course, it's just that we can't start discussing private projects online now. The reality is that there are a lot of transactions that have been done by banks alone, and these are good and bankable deals. But for a fresh project, greenfield, it's advisable that you co-finance with other banks. Thank you.
Thanks, Diron. So thanks to all our participants for sticking with us. There's loads of questions here, and we're just trying to keep running to enable our speakers get to them and give you their insights. I'll direct the next two questions to Dio. The first one will be, Dio mentioned that project finance takes between 12 to 18 months. Is this specific to a particular company, or is it varying amongst different companies, e.g. smaller ones or other indigenous operators? And I'll just tag on a follow-on question to that, if you have any insights. What exactly is the cost of producing a barrel of crude in Nigeria, and is it the highest in sub-Saharan Africa, and why? What are the key determinants of that price?
Okay, so let me start with the second question. What is the cost of producing a barrel of crude? The truth is that there's not, you can get to NNPC, and NNPC gives you like an average across board, but what it costs to produce crude differs from company to company. So if you're, for example, you're onshore, you're going to be spending a lot of money on security, and that also adds to your cost of crude. Now, would you say that the company is inefficient because it's spending so much on security? No, it's a cost that comes with doing business in Nigeria. Now, I'm not sure if the question is because of the break-even price of oil in Nigeria, because the break-even price of oil is different from the cost of producing a barrel of crude. Now, if you go online, there's always about Nigeria having the highest break-even price of oil. In sub-Saharan Africa, considering that there are very few of us that produce, we are probably one of the highest producers. But I know Angola has a very high cost of production too. But in terms of break-even has nothing to do with the operations, the oil and gas operations. Is more of how much must the price of oil be for the government to finance its budget. So if it's break-even, that's a totally different discussion, and that is not based on upstream activity. So I just wanted to clear that. Now, when it comes to oil, the older fields, the older JV fields, maybe in the 20s or in the 30s, but generally you can't pin it down. But I don't think we have any field that will be doing more than it's a range between 20 and 40, and I don't think it's the highest in the world, in the world actually. In sub-Saharan Africa, because we have very few that produce, it might be, but there are a lot of factors that go into it. And also remember that when you're looking at the cost of production, some of that cost is already sunk. So you have costs that are what you call cash costs. So you need to spend cash to get those costs paid. And there's also the depreciation of your oil and gas. That's also part of the cost of production, but that does not involve you spending cash. You had spent the cash in the past and you're just recouping it. So if you're looking at how much cash do I need to spend to bring a barrel of crude out of the ground, it ranges depending on operators between maybe 10, 15, and 30. But if you're now tagging on depreciation for the previous cost of developing the oil and gas fields, it might range between 20 to 40. There's not one straight answer, except you're looking at it from a DPR perspective where they have a dashboard. And then the second question was about, sorry, Deborah, can you just remind me what the second question was. Just that was the very first question he asked before the. Just slipped my mind for a minute.
Yeah, there are just so many high quality questions that I'm also.
Yeah, too
Yeah.
low downstream.
What was that? So you've answered
Um,
the cost of producing, which basically
yeah,
that's what you just answered. I think
yeah,
for the benefit of time, because we have just space for one more question actually. So because we're running out of time, we wanted
yeah.
to end this actually at 7:30, but we're 10 minutes over. That's okay. We're in the spirit. So let's see. So we have a range of questions here. Um, okay, a new
Oh yeah, yeah,
question.
yeah. So he was talking about financing. Is it
Yeah.
is it peculiar? Is it peculiar to a particular company? No, it is not. When you're doing financing, it's a very small world. So you are dealing with the same set of advisors, and we tend to talk. And for everyone that I know that has done, it takes 12 to 18 months. The last deal I was on was closing from when we started. We started September. The very first meeting was in September, and we got credit committee approvals and did allocation in March. That was the shortest, six months, but that was a refinancing. But even at that, to get all the other approvals still took another few months. So it's a general thing. It's not company specific. It's just the way it goes. There's just so many boxes to check and too many bankers to deal with.
Great. Thanks a lot for that, Dio. Really appreciate it. Really high number of questions coming through, and apologies if we've not been able to get to your question. We're just trying to avoid overrunning excessively. So thanks a lot to our distinguished speakers for sharing their experiences and insights. Thanks to Dio, Emeka, and Durand. You guys have really shared a lot with us today and lots of food for thought. There was one question I was actually going to look at, which was around where would you actually put your money if you could go out and invest right now. That would have been my choice to end with, but we can always follow up on that later on. So
Tesla or Zoom.
You know what? I would have loved if Emeka would have picked that up. Emeka, where should I put my money? That's essentially what the question is. Where should I put the money?
If you're thinking short term, downstream. The turnaround time is very short, and you're making your money real quick. Long term, oil producing asset is good, always good. And then, downstream, upstream, long term. Then second choice, midstream. Midstream is not really, but when you have an oil producing asset, you are talking big money. But short term, downstream is good. You can always find your way around it. The funny thing is that a lot of people from the downstream sector, based on the turnaround time of trade, were able to build up to acquire upstream assets. Like ITO used to trade at Sigmund, and then ITO today he owns an oil asset, one of the biggest right now on the side of NOC. Also, Britannia U also the same thing. She was a trader. Yes, I think with the two of them I know. So short term downstream, long term upstream, then midstream second choice. Thank you.
Great. Thanks for that, Emeka. I really appreciate it. I'd just like to say a big thank you again to our speakers for really sharing with us today and really giving us lots of food for thought and really getting into the meat of the subject. Really insightful. I've really found it very educational for me. Picked up a lot of new things. So just to close, I just want to give you a few heads up around the next webinar. So we're going to be looking at a theme of decarbonizing energy in sub-Saharan Africa. And as you can imagine, that's quite a wide topic with lots of interesting areas we could look at, and that's what we'll be focusing on for the next webinar. And currently we're looking at the middle of July, so either the 11th or the 18th. But those are tentative dates, but just bear that in mind if you have any plans for those dates. We'll be having another webinar there, which will be very insightful, engaging, and informative, just like what we've had today. I would just like to end by saying thank you to all our participants, both panelists, speakers, organizers. I hope you've really found this session as interesting and as engaging as I found it. And I think, you know, your time has not been wasted by any means. And I think it's been very, very useful and beneficial. So thank you again for attending, and join us next time.
So by the way, guys, if you're interested in having a copy of the slides, just send us an email. Debola, you have the email address on the screen. If you can put that on the screen, so our attendees, if they want a copy of the slides, can email us. We can send that to you. The video will also be available on YouTube and Vimeo within the next couple of days. We will send the link to your respective email addresses. Thank you very much, everybody. The email address is efikos@efiko.co.uk. So the same email address that replied to you guys when you did your registration, just send an email to that address. We'll send you a copy of the slides if you want to. And also we will send you the link where you can stream the video and share with as many people as possible. Really appreciate you guys coming through. Hopefully we well, made good use of your time, really, because obviously you guys must have had lots of things that you were planning for this weekend. But thank you for staying with us. We went 16 minutes over time. Considering the last webinar, we went an hour, 25 minutes over time. I think we're scaling in the right direction.
Continuous improvement.
Yes, continuous improvement. So by all means, any comments, criticism, anything you guys feel we can do better, by all means, please send that across to us. By the way, as Debola mentioned, this is an all-inclusive forum. So you guys that are watching us right now, if you are interested in presenting as part of the Efikos, by all means, this space is open. Please just drop us an email. For me personally, if I speak for myself, and hopefully the others share this, there's this narrative out there that there are not a lot of women in the oil and gas industry. I happen, in my workspace, have met lots of women in oil and gas, and not just at mid-level, at top levels. So we are encouraging, you know, because we want to promote a diverse platform here. So please, by all means, join us in this movement. The next topic, as Debola mentioned, decarbonization, is one that is particularly close to my heart personally. So hopefully we can get as many of you on board as well. Thank you, everybody, and have a great evening. Cheers.